If you're holding gold or silver right now, I want you to pause and really listen, because the next move could be the kind that unfolds quickly, feels unreal in the moment, and then leaves people looking back saying, "How did I miss that?" I'm recording this on Monday, January 26th at 9:20 a.m. New York time. Drop a comment with the time you're watching this, because I'm honestly curious who's down here with me in the trenches. And a quick side note, the analytics show that a huge number of you watch these videos regularly but still haven't subscribed. If you find value in this kind of deep dive analysis, hit that subscribe button. It helps the channel more than you might think. Also, once you're done watching, check the description. I've left some bonus links there, including access to a premium WhatsApp channel and a channel membership option. Now let's get into the uncomfortable part, and I'm going to be very direct about this. The real catalyst for what's coming isn't a meme stock. It's not a flashy headline about a famous investor, and it's not even the metals market itself. The real tripwire is the bond market, and if that wire snaps, silver can move in a way that makes today's price look like a misprint. Most people underestimate bonds. They see them as dull. They think bonds are for retirees, for conservative portfolios, for people who wear khakis and debate tiny yield differences. That mindset is a mistake, because bonds are the plumbing of the financial system. They're the floorboards everything else is built on. And when those floorboards start to creak, everything above them begins to wobble, even if the stock market still looks cheerful on the surface. Here's the mental framework I want you to keep in mind. In previous market blowups, the initial spark came from areas that were massive but still somewhat contained. The tech bubble burst and wiped out enormous amounts of paper wealth. The housing crisis imploded and infected bank balance sheets. Those were huge events, no doubt about it. But this time, the issue sits in the one place governments and central banks absolutely cannot allow to fail: sovereign debt. That's why this matters so much. Government bonds aren't just another asset class. They're collateral. They're what financial institutions use to prove stability. They're where funds park capital when they want to look safe. They're treated as the closest thing to risk-free in the system. So when the so-called risk-free asset starts shaking, the entire concept of safety gets questioned. And when safety is questioned, people don't slowly and politely rebalance. They rush for the exits. I'm not here to tell you that the bond market is guaranteed to collapse tomorrow morning. What I am telling you is that it doesn't need to crash to cause chaos. A sharp decline in bond prices over a short period is enough to light the fuse. That kind of move forces leverage to unwind. It triggers margin calls. It pushes big players to sell what they can, not what they want. Here's the detail most people overlook. Bonds don't need to move much to matter a lot. When you're dealing with instruments used as collateral and held with leverage, a move that looks minor on a chart can be devastating in reality. A couple of ugly days can tighten funding markets. And once funding tightens, liquidity vanishes in places you didn't expect. If you've ever heard people talk in hushed tones about the repo market like it's some secret society, this is why. Short-term lending and collateral markets are basically the heartbeat that keeps large institutions functioning day to day. When bond prices fall, collateral values fall. When collateral values fall, borrowers have to post more, or lenders pull back. When lenders pull back, you can get a chain reaction that looks calm on the surface, until suddenly it isn't. And don't assume this is only a domestic issue. Stress in government bonds travels. Major foreign holders adjust exposure. Pension funds rebalance duration, banks reshuffle balance sheets. Even small shifts in how large players manage safety can create outsized moves, because the bond market is enormous and deeply interconnected. Here's a cliffhanger you need to remember. The first sign of a serious problem is usually not a dramatic crash. It's a strange day where things stop behaving the way they're supposed to. A weak auction, a sudden intraday spike in long-term yields, a gap that gets brushed off as positioning. That's the market quietly telling you demand for paper promises is getting shaky. When that happens, the response comes quickly, because policymakers understand one thing very clearly. You cannot have disorderly moves in sovereign debt without breaking other parts of the machine. That's when temporary tools turn into permanent habits. That's when the language shifts from fighting inflation to preserving financial stability. And that shift is rocket fuel for assets that don't rely on someone else's promise to have value. This is where the story turns dangerous, and also where opportunity shows up. When the bond market is under stress, central banks have two choices. They can allow yields to rise and let the pain spread, or they can step in, directly or indirectly, and inject liquidity. In plain English, they either let the pressure build until something breaks, or they start pouring water into the pot. And that water is new money, new credit, new support, whatever polite label you want to use. And if they start pouring water into the pot, what floats first? Hard assets, real assets, things that can't be created with a keystroke. This is the part people consistently get wrong. They assume metals move slowly. They imagine a gentle, gradual climb. They think it's like watching paint dry while the world politely falls apart in the background. That's not how these moves usually play out. They're quiet, 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 and then violent. Silver, in particular, has a personality that catches people off guard. Gold is the heavyweight. Gold is respected. Gold is openly held by central banks. Gold moves with a sense of gravity and dignity. Silver is the wild card. It's the market that looks calm, right up until it isn't. It's smaller, it's thinner. And when the crowd rushes in, there simply isn't enough supply available at current prices to absorb that demand without price jumping sharply. That's why people who've watched this space for decades keep saying silver can outperform gold when the cycle turns. Not because silver is more important historically, but because it's more sensitive in real time. You've probably heard competitor-style claims floating around that silver could shoot to absurd levels quickly, hundreds of dollars an ounce and beyond. I'm not going to promise you a specific number like it's guaranteed. Anyone who claims they know the exact top and the exact date should raise a red flag for you. But I will say this. The math that makes people even discuss those numbers isn't pure fantasy. It's rooted in how stretched the gold to silver relationship has been for a long time and in how little it takes to reprice a tight market. Let's talk about that relationship without turning this into a boring history lecture. For long stretches of history, silver wasn't treated like an afterthought. It was money, right alongside gold. In earlier monetary systems, gold and silver were partners, not distant cousins. Over time, that relationship became distorted, and modern markets have swung the ratio like a pendulum. In recent decades, that pendulum has spent a lot of time with gold, priced at dozens and dozens of ounces of silver, often far above what older systems would have considered normal. That doesn't mean the past must repeat exactly, but it does mean the rubber band has been stretched. And when stretched relationships snap back, they often overshoot. They don't politely return to average and stop. They swing past it because markets are driven by human emotion. Think of gold and silver as two runners in the same race. Gold has maintained a steady pace and has broken into new territory multiple times over the years. Silver has spent an absurd amount of time jogging in place, tripping over its own feet, and getting mocked by people who aren't paying attention. But history shows silver doesn't stay humiliated forever. When it catches a second wind, it doesn't creep up 10%. It makes people do a double take. What matters right now is that silver has started acting like it wants to lead rather than follow. When that shift happens, it usually signals a change in the market's appetite for risk. It suggests people aren't just hedging with gold anymore, they're reaching for the asset that can explode. You can see hints of this in how silver has been closing relative to gold and in how pullbacks keep getting absorbed. That doesn't guarantee a straight line higher, but it does show a change in character. So what's the trigger again? We come back to bonds. When bond prices fall, yields rise. When yields rise quickly, financing costs increase. When financing costs increase, the economy slows. When the economy slows, politicians panic. And when politicians panic, central banks get creative. That creativity is what metals holders are really betting on. You don't buy gold and silver because you want to win a chart reading contest. You buy them because you don't trust the system to remain stable. And lately, the system has been anything but stable. Recent market developments show stress popping up in strange places, weak auctions, violent intraday swings in long-term rates, and headlines that only appear when insiders are paying attention. It's not always loud, but it's there. Here's the uncomfortable question. What happens if the bond market doesn't just drift lower, but drops hard for a few days? That's when fear shows up. Not the slow academic fear of a recession forecast, the fast, visceral fear of, what do we do right now? That's when you see emergency messaging, surprise liquidity programs, and policy shifts rolled out over a weekend. And if you think that sounds dramatic, ask yourself why central banks worldwide have spent years building market-functioning playbooks. That phrase exists for a reason. Now let's bring this back to you. If bonds wobble, the average person doesn't rush into bonds. They run away from them. So where do they go? Stocks? Maybe. Until stocks start sliding too. Cash? Not if they're watching it lose purchasing power. Real estate? Not if financing costs are high and transactions freeze. That narrows the list quickly, and sitting right there in plain sight are assets that have been real for centuries, gold and silver. Silver adds another layer that makes this even more interesting. And this is context you probably didn't hear in that competitor clip. Silver isn't just a monetary metal, it's also an industrial metal. It's used in electronics, medical devices, water purification, and one area people consistently underestimate, solar technology. When economies push electrification and energy transition projects, silver demand doesn't politely step aside. It shows up. Then there's the inventory angle. A lot of silver isn't sitting in vaults waiting to be sold. It's embedded in products, locked into supply chains, held in forms that don't quickly return to market. So when investment demand rises, the available float can feel far tighter than people expect. On top of that, silver supply is stubborn. Much of it is produced as a byproduct of mining other metals. That means even if silver prices rise sharply, you don't immediately get a flood of new supply. The production pipeline moves slowly, so you have a market that can see investment demand and industrial demand surge at the same time while supply lags behind. That's not a promise of $500 silver, but it is a setup for sharp repricing if the financial system panics. Now let's talk psychology, because this is where people get trapped. When silver first starts moving, most people don't believe it. They call it a fake out. They say it's overbought. They predict it's about to get smashed. And yes, silver does get smashed at times. That's part of its personality. But the bigger risk is waiting for the perfect pullback that never arrives and then watching price run away without you. I think about it in phases. Phase 1, nobody cares, and the diehards accumulate. Phase 2, the move begins, people argue, and weak hands get shaken out. Phase 3, the move becomes obvious, and the crowd arrives late. Phase 4, it turns into a headline and blow-off behavior follows. If we're entering phase 2 or 3, the most confusing part is that you can get a nasty mid-run pullback that convinces people it's over, right before it launches again. Here's another cliffhanger. If that stumble happens, where does it occur? At the obvious level everyone is watching, or at a level so absurd it forces conversation. That distinction often separates a forgettable move from a legendary one. Now let's compare this with gold, because gold's story matters for positioning. Gold has already proven it can make new highs across long cycles. It's done so under different presidents, different economic conditions, and completely different narratives. Gold doesn't need hype, it needs the right conditions. And those conditions usually come down to trust in paper and trust in policy. When purchasing power is being eroded, gold doesn't ask permission to rise. One of the simplest ways to think about gold is that it's a mirror. It reflects trust. When trust fractures, gold shines. If you study past major gold cycles, you'll notice something interesting. Gold tends to make large percentage moves from deep lows to cycle peaks. Not in straight lines, but in wide arcs. Apply that kind of cycle logic to the current environment, and you get numbers that make people uncomfortable. Not because they're impossible, but because they force you to confront how much currency value has already been diluted. That leads to the next uncomfortable question. If gold's historical cycle behavior repeats in a world with higher debt and more aggressive policy tools, what does normal even mean anymore? And if gold does what it's historically done, silver's catch-up move becomes the real spectacle. But we're not finished, because there's a third layer most people ignore until it's too late: miners. Mining stocks are the awkward middle children of this space. People either love them or hate them. They expect lottery ticket returns or swear them off entirely. But miners matter because they represent leverage on top of leverage. When metals prices rise, miners can rise more because revenues move with the metal while some costs stay fixed, at least in the short term. Miners have been left behind in many investors' minds for good reasons: bad capital discipline in past cycles, dilution, rising costs, and general fatigue. But that's also where opportunity can form. When an asset class is hated and macro conditions force attention back to it, repricing can be violent. Based on recent filings and industry updates, many miners have been forced to clean up their balance sheets compared to previous eras. Not all of them, but enough to matter. I'm not saying every miner is a winner. Plenty are traps. But the broad undervaluation argument isn't crazy. Relative to metal prices, many mining equities have traded for years as if nobody believes the metal's move will stick. When the market finally believes, capital often rotates into miners seeking torque. And if silver leads, silver miners can become the part of the trade people talk about at backyard barbecues. Here's another cliffhanger. If the crowd really shows up, do they buy physical metal or do they chase stocks because they think it's faster? That answer matters for how the next leg unfolds. Now let's zoom out to the broader stock market, because this is where I partially agree with the competitor narrative, but with sharper edges. Stocks can absolutely roll over hard in a stressed macro environment, but it's rarely a straight plunge on a calendar date. Markets like to torture the most people possible. More often, you get a topping process. Rallies that look like breakouts, followed by drops that feel catastrophic, followed by rebounds that lure people back in. That's how distribution works. When you zoom out and study momentum, participation, and narrowing leadership late in cycles, you start seeing exhaustion. The question isn't whether stocks can fall. Of course they can. The question is what forces them to fall fast. And again, you come back to rates and liquidity. A jump in long-term rates changes valuation math, refinancing costs, consumer behavior, and government behavior. Higher rates mean higher interest expense, and that's where bonds stop being academic and start becoming a political emergency. Let me inject some skepticism here because I don't want this to be pure hype. Could central banks prevent a full-blown bond panic by stepping in early? Yes. Could they smooth things out into a slow bleed instead of a waterfall? Yes. Could they use tools that don't look like printing on the surface but accomplish the same goal? Absolutely. So if you're waiting for a dramatic crash candle to confirm everything, you might miss the real signal. The real signal is confidence eroding. The real signal is the market forcing the policy response. And that response, whether it's called liquidity support, market functioning, or some friendly sounding facility, tends to be bullish for hard assets over time. Now let's talk about the dollar, because this is where people get twisted up. They look at the dollar index and think that's the full story. It's not. The dollar index mostly measures the dollar against other major currencies. That means the dollar can look strong on the index while its real purchasing power is still being hollowed out. You feel that erosion at the grocery store, in insurance bills and rent, and in the cost of anything tied to energy, labor, or materials. Yes, you can look at money supply growth as a scoreboard. Broad money expanded aggressively in recent years, and even after periods of contraction, the overall level remains far above where it was before emergency policy became normal. When you increase the amount of currency chasing goods and services, prices adjust, sometimes slowly, sometimes all at once. Here's how it all ties together. If the bond market starts breaking down, policymakers will try to stop the bleeding. That usually means easier financial conditions in one form or another. Easier conditions tend to erode purchasing power over time. And weaker purchasing power pushes investors toward assets that hold value across regimes. That's the cycle. That's why gold and silver keep re-entering the conversation whenever confidence wobbles. Let me ground this in something practical. If you've already been stacking and watching this, you're not crazy. You're early. There's a difference. If you haven't done anything yet, you're not doomed, but you are on a clock. The moment silver starts making new highs and holding them, the entire tone changes. The jokes disappear, the dismissiveness vanishes, and the should I buy questions flood in, usually when the easy gains are already gone. So here's a question for the comments. Do you think the next major crisis starts in stocks or in bonds? And another one, if silver suddenly printed a price you never expected, would you feel excitement or regret? I promised retention, so let's get more specific without turning this into a spreadsheet. There are psychological levels in bonds that matter. When key bond prices break below areas big players have been defending, it triggers forced selling, systematic strategies, and risk parity adjustments. That's how cascades form. And once a cascade begins, the response is fast. When responses are fast, metals can gap higher. If you're waiting for polite confirmation, speed can run you over. Another overlooked factor is global synchronization. This isn't about one country. Major economies everywhere are loaded with debt and face demographic and productivity headwinds. The temptation is the same across the globe. Keep financing easy, keep the system afloat, kick the can. That means currency debasement isn't isolated, it's global. And in a global environment like that, hard assets start acting as the common denominator. That's why central banks still hold gold even when they pretend it's outdated. They don't hold it for nostalgia. They hold it because it sits outside the paper promise system. And when the public remembers that, the move can become impossible to ignore. Quick reminder before we go deeper. If you've been successful, share your story in the comments. People read those and they matter. And if you want deeper research, we do offer members-only videos produced by a separate team that digs harder into the data and builds tighter models. Those are available through the join link in the description. Back to the market. One of the strongest cases for silver isn't just that it's cheap relative to gold. It's that it's been psychologically abandoned. It's been treated as the metal that never quite delivers. Markets love embarrassing the largest crowd. When everyone believes silver can't hold a breakout, the moment it does, positioning has to change. And then the chase begins. Here's an uncomfortable truth. If silver experiences a true blow-off move, it won't feel safe. It will feel insane. It will feel like it's about to crash every single day. Euphoria and panic will exist at the same time. That's why most people won't capture the full move. They'll sell too early, buy back higher, sell again, and then watch it do exactly what they feared. Winning isn't about perfection. It's about having a plan. And yes, that plan can include taking profits along the way. That's not weakness, that's survival. Now let's loop miners back in because they add another psychological layer. When metals rise, miners often lag at first because disbelief dominates. Then miners start moving, and that's when equity investors begin paying attention. Once miners break out, generalist capital can rotate in, creating a feedback loop. But miners are businesses. They come with execution risk, jurisdiction risk, and cost inflation risk. You can't blindly buy anything with silver in the name and expect magic. That's why I think in tiers: strong balance sheets and quality assets first, then higher risk names if you know what you're doing. What about the broader stock market during all this? If we get a serious equity drawdown, miners can drop too, because liquidity events force selling across the board. But when metals are in a real bull phase, miners often recover faster because capital hunts for what's working. Sequence matters, bonds wobble, policy responds, metals ignite, miners follow. And suddenly you have parts of the market down while metals-linked assets are up. That disconnect confuses people, but it's simple. Capital flows toward oxygen. Let's return to purchasing power for the big picture view. Over generations, currency buys less. That's not politics. It's math. That's how a debt-based system behaves when policy consistently chooses growth and stability over strict discipline. You don't need charts to see it. You need memory. What did homes cost decades ago? College? Everyday life? Prices didn't explode because everything became magical. The unit of measurement weakened. So when people say gold is rising, it's often more accurate to say currency is falling. And silver is tagging along, with the added potential to overreact because it's smaller and more volatile. The competitor narrative frames this as an instant doomsday. I'm more cautious. The path can be messy, jagged, full of fake-outs. But the destination, higher nominal prices for hard assets in a debt-heavy, policy-driven world, makes sense. And if bonds are the pressure point, timing can compress because policymakers move faster when cornered. Here's another cliffhanger. When bond stress becomes obvious, do people rush into gold immediately? Or do they first pile into cash and short-term safe instruments? Often it's the latter. But if stress persists and policy turns inflationary, metals become the second act. And second acts are often bigger than the first. I'll speak directly to two groups now. If you already hold metals and you're feeling uneasy, don't let daily volatility erase your long-term thesis overnight. Watch bonds. Watch policy language. Watch real yields. Watch the narrative shift. If you don't hold metals and you're skeptical, I respect that. Skepticism keeps you alive. Just don't confuse it with denial. Build a framework so you can act if signals change. And if you act and it works, share your story. Those comments help people stay grounded when things get strange. Before you click away, here's a simple way to track this without staring at charts all day. Watch the long end of rates, especially days when yields spike and don't fully retrace. Watch credit stress, widening corporate borrowing costs even when stocks look fine, and watch real-world metal demand like tightening retail availability and pullbacks that get absorbed quickly. So tell me in the comments, are you watching bonds or are you still focused only on stocks? And are you holding more gold, more silver, or neither? As always, keep your head, keep your standards, and don't outsource your conviction to the crowd. And one last reminder, everything we discussed here is for education and perspective, not personalized financial advice. I don't know your situation, timeline, or risk tolerance. Don't treat a video like a custom plan. Use it as a starting point.